Welcome everyone back to the Noob Selling Options channel. Today we're going to dive into a classic Wall Street drama. You've got a market darling, ServiceNow, they report earnings and boom, the stock just tanks. So we're going to break down exactly what happened and see if we can turn all that market fear into a real, clear-eyed opportunity.
Yeah, this is the big question, right? When a high-quality company that you love takes a sudden double-digit hit, your first instinct might be to panic. But a lot of times, these are the very moments that create the biggest opportunities for us.
Okay, let's get right into it. First things first, we need to understand why the market reacted so badly, especially when, if you just glance at the numbers, the earnings report actually looked pretty solid.
So here's the thing that's kind of crazy. The panic wasn't even about the quarter that just ended. It was all about looking forward, into the future. And there were three key things that really spooked investors. One, that massive $7.75 billion acquisition they made is going to squeeze profit margins for a little while. Two, growth is slowing down. I mean, just a tiny bit, but the market hates that. And three, there's this broader anxiety out there, this SaaS apocalypse fear, that maybe ServiceNow's valuation was just way too high to begin with.
And this is where the story gets really fascinating. Despite all that negativity, the actual business performance was strong. They brought in almost $3.8 billion, which beat what everyone was expecting. And get this, they actually raised their forecast for the rest of the year. So you have this huge disconnect. Strong performance, falling stock price. That's exactly what we're here to figure out.
And this number right here, 98%, this just shows you the incredible, powerful underlying strength of this company. That's their customer renewal rate. A 98% renewal rate it's just insane. It's almost unheard of. It tells you they have an incredibly sticky and loyal customer base that truly depends on their platform. This is not a company that's in trouble.
So how do we cut through all that noise, all that fear in the market, and figure out a logical price for the stock? Well, we're going to use a really simple but super effective tool to help us model out the future.
And we're going to use the PEG ratio. In simple terms, it just helps us answer the question, am I paying a fair price for this company's growth? A PEG of 1 suggests the price is pretty much perfectly in line with its earnings growth. So let's use this to build two totally different scenarios for ServiceNow.
All right, let's start with our first model. We'll call this the steady growth model. Here, we're just going to assume ServiceNow keeps up its strong performance and maintains a really steady growth rate for the next 3 years.
So if you look at the table, if we project their earnings per share, their EPS, growing at 20% a year, you can see it compounds from $4.18 all the way to over $7.20 in just 3 years. Now, if we apply a PE ratio of 20 to match that 20% growth, which gives us that perfect PEG ratio of 1, we get a target price of over $144. That is a significant upside from where the stock fell.
But what if that 20% growth doesn't last forever? And this brings us to a really crucial concept for any growth investor, multiple compression. It's what happens when the market becomes a little less willing to pay a super high price for a company's earnings, even if those earnings are still growing.
So let's see how this idea of multiple compression factors into our second, more conservative model. This is the humble model. It assumes that ServiceNow's growth, while still really strong, is going to gradually slow down a bit over the next few years.
In this scenario, as you can see, we've got growth tapering from 20% down to 16%. Now, the earnings still grow nicely. They reach almost $6.90, but notice what happens to our target price. Because the growth rate is lower, the PE multiple the market is willing to pay also shrinks. This multiple compression acts as a headwind, right? And it leads to a more modest, but still really positive, price target of almost $110.
So the crucial point is this. When we lay the two scenarios out side by side, even our most conservative, humble model projects a fair value that is significantly higher than where the stock crashed to after earnings. To me, this suggests the market's reaction was a total overreaction.
Now, this analysis is all well and good, but how do we turn it into a real, concrete action? Let's look at a real-world example of how I put this thesis to work. And here you have it. This is the analysis put into action. In the hours right after the drop, a trade was executed. I sold 5 shares of a different strong performer, Amazon, just to free up some capital. And that capital was then immediately used to buy 10 shares of ServiceNow at that new, much lower price.
This is a classic reallocation. It's all about taking some profit from a stock that's done really well and redeploying it into another high-quality company that seems to be on sale. In this case, it's about strengthening a portfolio of top AI-related companies.
You're taking direct advantage of that multiple compression we just calculated, using the market's short-term fear as a long-term opportunity.
So let's wrap all this up. What's the plan moving forward? And what's the key lesson from this whole exercise?
The strategy is pretty clear. I've started a position, but the work isn't done. The plan is to stay disciplined and be ready. If continued market anxiety pushes the price down even further today, it's an opportunity to add to the position at an even better value. I'm ready to buy up to 10 more shares.
Now I want to turn it over to you. Looking at these two models, what do you think? Did the market overreact? Is ServiceNow a buy right now, or are you staying away? Let me know what your move is on NOW down in the comments. And hey, if you found this breakdown helpful, be sure to hit that like button and subscribe for more. Thanks for watching.